Today, we're going to be talking about filling up your tax bracket. Have you heard this term before, or did I just make it up? Now, I've heard it, but I don't think it's very popular. But basically, it's trying to get as little amount of taxes paid, but by paying taxes, meaning let's fill up our tax bracket because it's only 12%. And does that decrease your overall tax in the long term? Yeah, usually it does. So we're going to talk about today specifically about this idea of filling up your tax bracket, but more specifically, I'm going to give you three pitfalls or three considerations that most people that are thinking about this don't realize. Let me bring in my co-host, Tony Shore. Tony, welcome to the show. Have you heard this term, filling up the tax bracket? Have you heard this before?
No, and I think it's just a typo on your part, so you're rolling with it. It should be tax bucket, right? I think you're missing the word free in there, and it should be bucket instead of bracket. Filling up your tax-free bucket.
Nope.
That's I've heard a lot about that. You've talked about
tax
that.
buckets,
So
yes.
you're
No,
coming
this
up with
is
a show name and a show idea, and instead you accidentally wrote bracket instead of bucket.
No,
And
I meant
then
it.
you just had to run with it, or what
I'm going to
happened?
run with it. It's like, I'm going to keep going with it all day. I got all these stats for us. I'm going to keep going.
Never heard of filling up your tax bracket. No.
Okay. So we know what tax brackets are. For the audience, I put them on the screen here. We got the first tax bracket is 10%. So what does that mean? That means you pay.
That means you're a radio show co-host. If
Yeah,
you're in
right. Right. Your income's, you pay 10% tax. Federal. We're talking federal. We're not talking state.
Right.
Yours is even more in Minnesota.
Oh, yeah. Don't get me started.
Then after the 10%, you bump to the 12%, where a lot of Americans fall. And then you go to the 22%. That's a big jump. You go from 10 to 12, and then there's a 10% increase to 22. Then it goes 22 to 24 to 32 to 35 to 37.
37 would be Dan Wendell, and
no
10% tax bracket would be Tony Shore. So just to give you an idea.
Let's give you some, do we do single or married? You could cut this in half if you're single, but let's look at the married 2025 tax bracket for a married couple. What's the 10% bracket? That means you make between $0 and $23,850. So we'll call it 24 for easy math. So if you make between 0 and 24,000 of taxable income, you're paying 10% to the government, IRS. Once you get past 23,850, so now you're at 23,851, every dollar you make past that, you're paying 12% tax up to 96,950.
But it's only the money after that amount.
Right. That first 10%, if you're making $1 million, that first 10% bracket still exists for you. So you're paying $2,385 to the government for that first 23,850. That doesn't change. It's progressive. So it's not like, once you get to the next tax bracket, you're going to pay that percentage for everything. It's a new bracket, right?
Sure.
So what a lot of people talk about, and especially when they're talking about Roth conversions, is they say, well, let me fill up the 12% tax bracket, because 12% is pretty reasonable. Married couple, they're like, you know what? I don't mind paying 12%. I have a feeling tax rates might go up in the future. And so why not fill up my tax bracket? So what does that mean? Now, you get your standard deduction as a married couple, right? So you might actually be able to show 130,000 roughly of income and still be in the 12% tax bracket, because this is taxable income. 96,950 is taxable income. So as long as you're below that, you're paying 12% on your income. So a married couple that has, say, 60,000 of income, they could fill up their 12% tax bracket by showing an additional 36,000 of income and pay 12%. So you're not getting like free money. You're just saying, hey, 12% is good. I'm okay with paying 12%. Why don't I take advantage of it and pay 12% on as much as possible, and then stops my income right before that, so I don't go to the next.
So you're talking about if you have room in your tax bracket.
Yes.
So you're talking about if you're in that 12% tax bracket and your income is 60, you've got room where you could have another taxable event and still only pay 12%.
Correct.
So it gives you room to play with if you want to pay low taxes on an IRA withdrawal in retirement.
That's
Or
right.
is that, and are you mainly talking about people who are retired, or is this for during your working years as
These
well?
brackets are irrespective of your age.
Right.
So,
But
however,
filling up the tax bracket you're talking about, is that a strategy mainly if you're in retirement?
yeah. However, one of the considerations deals a lot with any age. But yes, let's talk specifically about retirees because that's what this show is about.
Right.
Um, a lot of people focus on filling up their tax bracket for Roth conversions. So taking a withdrawal from an IRA, paying the tax up to their next tax bracket. So usually it's the 12% tax bracket, or it's let's fill up the 24% tax bracket because it goes from 24% to 32, and that's a big jump.
Yikes.
But
Yeah.
the 12 to 22 is the biggest jump. So that's why most people
I get
fall
it.
there. So when
And if
people
you're in
start
that area and you want to have a tax-free income bucket in retirement, that's your opportunity to do the Roth conversion. As
right.
you always hear such great things about Roth conversions. You've talked about them on the show. For
Mhm.
many people, not all, it's a great tool and a great thing to be able to convert your traditional taxable retirement accounts to
Mhm.
a Roth, and
Right.
that grows tax-free and comes out tax-free.
Right. But you have to pay the taxes now, and that's like, well, I'll pay the 12% now so that I can have tax free in the future. Or a lot of people, and this is something I promote for a lot of people, is all right, let's fill up the tax bracket at 12%. Take the money, don't convert it to a Roth, spend it, give it away, use it now while you're young because life is short, right? So I often say that too. So it doesn't matter if we're talking a Roth conversion or
In
just taking the
retirement,
money.
let's not confuse people who are they think, "Well, I'm young, I'm 45, let me." No, we're talking about in retirement when you
Well,
first retire.
you could do a Roth conversion at 45. I did one in my 30s because I was in a situation where my family had no income one year or low
Sure,
income one
sure.
year. So we were able
Oh,
to
yeah, you
fill up the tax
can,
bracket.
but I'm talking about your theory of spending it,
Well,
instead
yeah.
of yeah,
And that's the other thing. If you're under 59 and a half and you pull from an IRA, there's a 10% penalty for early withdrawal.
yeah.
So we're not talking about that. But the thing that I want to bring up is the three considerations that you should be thinking about when you're doing this, because most people get the idea of, oh, 12% is reasonably low, relatively speaking. I get the idea of filling it up. But before you fill it up, because you want to just pay the 12% while you can, consider these other things because they can trip you up. First consideration, in no order, is Social Security taxation rules are different than ordinary income tax rules. Okay. So you could find yourself as a married couple in a situation where your only income is Social Security. And you're thinking about, well, let's do a conversion now because we only have $50,000 of income. That gives us $46,000 of room to fill up our bucket. Actually, even more because of the standard deduction. But should you do it? Well, if you do, here's something to consider. Social Security is not taxed if your income is low enough. And granted, those brackets for Social Security taxation was set in the 80s, and the formula, which is provisional income, is not. It's a little different. It only counts half of your Social Security income. Was set in the 80s as well. If you decide, all right, I have 50,000 of Social Security income, me and my wife, I want to fill up the tax bracket. You could put yourself in a situation of paying zero tax on your Social Security, zero, because of the way that taxation works. Watch a video. We've done plenty on Social Security. I'll put that up there on taxation of Social Security. You can go from paying nothing on Social Security to having 85% of your Social Security benefit taxed as ordinary income. So you'll have no taxation on Social Security, and now you're paying 12% on 85% of your Social Security by just because you filled up the tax bracket. So that's a huge difference. Oh, granted, you're only paying 12% on that extra that you filled up, but now you're paying 12% on your Social Security income when you weren't paying it before. So that's a consideration. Don't put yourself in a situation without thinking about the taxation on Social Security. That happens to people. Oh, I did a Roth conversion because I was only in the 12% bracket, but my tax bill went up by much more than I thought. What's going on? Now, because your Social Security is taxed now, and it wasn't
Mm.
before.
So that might negate the strategy of filling up that tax bracket,
It might negate it or at least hinder it a little bit. Not saying
depending
you
on where
shouldn't
you're
do it.
at.
Right.
Depending on where you're at.
It's particularly important for people with lower incomes because those brackets for Social Security are pretty low. The married filing jointly provisional income is 44,000. If you're less than that, then if you're more than 44,000 of provisional income, then 85% of your benefits will be taxed. Social
Wow.
Security benefits. But 44,000 provisional income only includes half of your Social Security. So there's some room there. So that's consideration.
Yeah, the
A.
formula is different as well. It's not
That's right.
just based on your gross adjusted, right?
Right. It includes only half of your Social Security income.
Yeah.
So that's consideration one. Consideration B, long-term capital gains taxation rules are different. And this trips people up too, not just retirees. So, all right, Tony, let's use the example you and your wife are making 50,000 or whatever, and 50,000, and you're like, oh, I got another 40, I can, fill up my 12% tax bracket, right? Same scenario. And they're like, well, should I do a Roth conversion? Well, all right, maybe that makes sense. And maybe you're not on Social Security. So it's like, I don't have to worry about that. We're delaying our Social Security. Another reason why you might want to delay Social Security is now you can do some Roth conversions or long-term capital gains. Now, long-term capital gains has a different tax bracket. They have different rules. In 2025, a married couple can have between $0 and 96,700 of long-term capital gains, and the tax bracket on that is zero. So let's imagine a weird scenario where you have zero income and you have some long-term capital gains because you own a property, farmland, or maybe you have a stock account. You bought Apple years ago and you have 100,000 of gains. If you sold that Apple stock, you show 100,000 of gains. The first 96,700 would be tax free. So when people start filling up the brackets, I often say, well, let's look. Do you have any long-term, meaning you've held it for over a year, long-term capital gains? Because maybe we start there instead of doing a Roth conversion, because you're paying 12% on the Roth conversion in this scenario, where you could be paying zero on the long-term capital gains. It's like, well, what do you mean zero? I can pay no tax? Yeah. So now it's not just $0 on the gain, meaning if you have 100,000 of long-term gains, but you also have 100,000 of income, your overall taxable income is 200. So now you're in the 15% tax bracket for the long-term gains. But sometimes people get tripped up by that. They think, oh, I have 20,000 of long-term gains. I get no tax. The first 100 are free. No, it depends on your income. This is your income overall. So I think people forget this. I think people forget that long-term capital gain, they know long-term capital gains are taxed differently, but they don't consider it when they're filling up a tax bracket. They're all more concerned about IRA withdrawals as opposed to realizing long-term gains.
Interesting. Yeah, the long-term gains one throws me off, and I think it would throw a lot of people off, and it confuses people because there are a lot of rules around that people aren't quite aware of. The Social Security one I was aware of, and there's a lot of information out there about that. In fact, the show we've done, people can figure that out. But long-term capital gains, maybe we should do a show just on that at some point.
Yeah, I mean, we've done a show on long-term capital gains. I think it had to do more with the house.
Right.
But let's think about that. So say you're married and then your spouse dies. So you go from having a $500,000 long-term capital gains freebie, I'll call it, meaning you don't pay tax on the first 500 of long-term capital gains on a sale of your primary residence. But if you're single, that's 250. So if you lose a spouse and your exclusion on the gain goes from 500 to 250, and you actually have, say, 350 of capital gains, you can only write off 250, so you're responsible for that other 100. Maybe that's maybe when you sell that house, you time it so that
Sure.
you can get zero tax on it or whatever,
But long-term capital gains aren't just property, right? I
Right.
mean,
It's stocks, bonds, farmland, whatever,
yeah.
real estate deals, any sort of investment, records, LPs. Okay. Last consideration and not least, and we've done a couple of shows recently on healthcare, health insurance subsidy. Health insurance is expensive. And I said in that show that most people in this country get subsidized health insurance.
Yes.
For most, it's their employer paying half or more. So they don't realize the true cost until they retire.
Right. And it's bad, by the way.
And
FYI, if you don't realize the true cost, ask
and
Dan, who's
right.
self-employed. You run your own business, you know.
So however, let's say you're not getting it subsidized through your company, but you're on your own. You're probably getting subsidized health insurance through the marketplace. Healthcare.gov gives a subsidy. And let's say you're a married couple and you only have, it's like back to the $50,000 of income. Now you say, oh, I can fill up my tax bracket. You got to think about what your healthcare subsidy is going to do. So you might be getting $1,000 a month of health insurance subsidy every month, $1,000 for you and your wife to pay for health insurance. Sounds ridiculous, but it's very normal. That subsidy is going to be based on your income. So if you do a Roth conversion or you do a long-term capital gain sale or you do any sort of income to fill up that tax bracket, and now you've added 40,000 of income, your subsidy is going to go down. So your subsidy can go from 12,000 a year to 5,000 a year. And now all of a sudden,
and you have to make up the difference.
You have to pay $7,000 more a year for health insurance simply because you filled up your tax bracket by doing a Roth conversion or whatever you did.
All of a sudden, you're paying $500 more a month
right.
for your health care.
Right. So you're
saving. That's a big increase.
You're saving on taxes.
Yeah.
But you're losing on the health insurance subsidy. So it's interesting to consider. And that's a complicated math formula, and people don't do it. They just say, oh, Roth conversion, let me do it. Or let me realize that capital gain at 0%. And now why am I paying more for health insurance? Because it's based on income, not assets. And so you might be saying, well, Dan, I'm on Medicare. Medicare has its own and IRMA. We talked about IRMA before, income related adjustment amount, right?
What a mess. Like that ad on TV with the ants who come over. Yes. Expired. This is a lot of house. Sure hope you can keep it clean.
And IRMA's here. Knock. The good news about IRMA
is there's good news about IRMA?
No. You're not going to get good news from me, from the guy that wore a taxation is theft shirt last show. And IRMA comes in if you're married and you have 212,000 of income. So the income brackets start higher, and that's half for a single person, 106,000. So in 2025. So if you make above that, you're not in the 12% tax bracket anymore. So now we're talking about people trying to fill up a 24 or 22% bracket before they jump to the next bracket of 32. So IRMA kicks in then. And what that means is you pay more for your Medicare Part B. And
your Medicare premium each month goes up. Yeah.
And the IRMA brackets are a lot quicker, meaning 212. It's not like you have to make 400,000 for the next bracket. No, it's still in the 200s. So that is something to consider. But I think the big consideration is the health insurance subsidies or the penalty for IRMA. People don't factor that in when filling up a tax bracket. So those are the big three. I'm sure there's more, but filling up a tax bracket can be strategic, but you have to factor in these other things I talked about. Maybe it makes sense to do it over time. We've done our show, the Shawshank Roth conversion. That was my favorite made up term, Shawshank conversion. If you don't know what that is, watch the show. I love it. It relates to the movie Shawshank Redemption.
Sure.
And consider those other things if you're going to do it. Just don't be willy-nilly about it. You know what I mean? The only other thing that I think we should say about taxation is this.
Dolphin Financial Group does not provide tax advice. See a CPA for tax advice.
So that's it, Tony. What do you think? Well, you big three. Did you think of all of those?
Nope. The long-term capital gains. You got me on that one. I immediately thought of Medicare premiums, but it didn't really apply to the 12% tax bracket you were talking about, so I wasn't concerned about that. But the Social Security, I also thought about that. Long-term capital gains, you got me on that one.
Yeah, and
Never would have thought of it.
Not everyone has a non-qualified or non-IRA bucket of investment or property or any, but a lot of people have something, right?
Yeah.
So,
Yeah.
And you got to be strategic about it. Use the tax code, right? This is the whole Warren Buffett pays less tax than the secretary thing. It's because of the long-term capital gains, right?
Right.
Right. So know the rules, be strategic, and before you fill her up, do the math. That's all I'm going to say about that. Tony, thanks for another good show.
It was great.
We'll catch everyone next week.
Thanks, Dan.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.